So we've got a project under contract at the Gray Fund. It's a very hard environment to place projects to win them, to find opportunities. This is an off-market opportunity, but this is not just kind of fall into our lap. Was the result of over about a year and a half's work of communicating with an owner and actually going through a broker. So it did come through a broker, but we went direct, knowing that this owner had several properties in markets that we were interested in, making a connection through the broker to maintain our broker relationships. And this project was then brought directly to us. We then, put it under LOI, have been negotiating the contract, and we signed that contract yesterday. So let's take a look. So the property is called Club Meridian, and let me just move my my thumbnail out of the way so you can actually see what I'm talking about here. 406 units in Lansing, Michigan. Now it's in the Lansing MSA. It's actually in Okemos, Michigan, which is a suburb of Lansing on the southeast side of the city. Again, but it's its own town, Okemos. It's very suburban, and the property itself is beautiful and there's a great business plan, but we're very data driven and very focused on demographics. And the demographics in the market of Okemos are really everything that one would want when you're looking at a market to invest in for apartments. There's a couple of reasons why we like it. One, it's high incomes. We're going to look at the median household income. It's between 90 and 100,000. And the closer you get to the property, actually the demographics get better. Strong population growth over the last 5 years. It was growing at over 1%, 1.4% every single year. Projected strong population growth over the next 5 years. Great household growth, great jobs in the area. It's near Michigan State University, but not very many students live there. Corporate headquarters is right around the corner. Medical offices that provide great jobs are right in the area. So it's really kind of kicking on all the cylinders that we want to see, not to mention really not that much supply coming into the market. There's one project that they're building in just really the entire area. It's about 110 units. And when those units are delivered, they're going to have significantly higher rents. And we'll see that compared to some of the other newly built construction. How Club Meridian, which is the property, again, 406 units up in Okemos, Michigan, submarket of Lansing. We love this property because it has minimal physical obsolescence, which means that it doesn't look like an old property. It doesn't have like the bones that you can't make it into something else. It's very attractive unit layouts, floor plans. The architecture is still relatively modern. It doesn't look incredibly dated. They're still building apartments like this today. So again, it doesn't look that dated. Here's just another picture, looking at the blue skies. It's got a brick siding as well as some vinyl siding. The current owner has put quite a bit of capital into this project over the past several years. They bought it back in 2016. A lot of the money was put into the exteriors and really kind of continuing to maintain the asset. So they've put a lot of money in many of the right places. They've only recently started to do interior renovations, and they are getting really great rent premiums all the way up to $200 by just $3,500 per unit renovations. Now we're budgeting a little bit more than that, but essentially continuing what they've already proven out over a small percentage of the property. We are going to continue to roll that out throughout the property, get into the specific details in a minute. But another indication of demand is when we were up there touring just several weeks ago, renewal rates, the amount that rent is increased on existing residents, which usually isn't that much, very large. They're increasing renewal rates by 10%, and new leases are being increased by 15%. And that's just organic without really any renovation at all. That's just indicating the demand for the property itself. So looking a little at the details of the investment summary, some of the project details, property details, it's a relatively big deal. $77 million purchase price. Again, 406 units. It was built in 1989. Solid B plus class property. It's a stabilized property, 96.5% right now. It's basically sits between 95 and 97% over the last decade. And we'll look at that, but indicated a long history of strong demand. We're purchasing it right around $189,000 per unit, which is below current replacement costs. And we're looking at this for a relatively long-term hold, up to 10 years. Now, one of the reasons that we're looking at a 10-year hold as compared to like a shorter 5-year hold is the uncertainty in the market right now. There's a good chance that we will sell this asset prior to 10 years, and even a better chance that we'll refinance within the first 5 years. But with the market conditions as they are today, we did not feel that it was appropriate to bake in a refinance, not knowing what interest rates are going to look like in the next couple of years. But we believe that we will certainly be able to refinance this property in a couple of years and return quite a bit of cash. And we'll get to this also in a second, but we're using lower leverage on this acquisition. We're finalizing our debt terms as we speak, but right now we're looking anywhere between 55% and 65% loan to value. That is much lower leverage than a typical acquisition, even at Great Capital, and where we are typically using leverage around kind of about 75% loan to value or 70% loan to cost, and have even done projects up to 80% loan to value. So quite a bit lower leverage, 55 to 65% LTV. And so that means the returns are going to be perceived to be a little bit lower than if we were using higher leverage. And also if we were using a shorter hold period, because if you compress the hold period, your IRR increases because it's a measurement of time as well. We're looking at placing a fixed rate agency debt on the property itself with up to 5 years of interest only. And again, that will just really set up the project, lock in an interest rate at acquisition, completely eliminating and removing interest rate risk for the investment for the duration of the project, but still with the opportunity to add a supplemental loan that agency loans allow for, to be able to pull cash out once we force appreciation by adding value and increasing rents at the property itself. A lot of great amenities at the property. There's a pool, tennis court, there's a health club with a sauna, renovated clubhouse. The previous owner did a great job renovating the current clubhouse. Playground. We're also going to be adding a dog park. It needs a dog park. There's washers and dryers in every single unit. The roofs have been replaced recently. And overall, the property shows incredibly well. We were there a couple of weeks ago, like I mentioned. We'll be back shortly as well to conduct further due diligence. And the property, again, it just shows really, really well.